Hello, I'm Dr. Todd Jackson. Today we will be covering dollar value LIFO. Dollar value LIFO is an inventory measurement method that's applied to inventory pools, and it uses a cost index to remove the inflationary or possibly deflationary effects on year-end inventory values relative to a specified base year. This is to determine if there has been a real increase or a LIFO order decrease in inventory for the current year. The index values are then used to reset each year-associated inventory layer to the cost prevailing in the year it originated, thereby achieving a LIFO effect on reported inventory and cost of goods sold. So as noted, the dollar value LIFO method makes use of a cost index to remove inflationary or deflationary effects first. And the cost index can be either a published index that's publicly available, or it can be an index that is determined or derived internally. And as noted here, basically a cost index is just a series of values used to relate inventory costs from one year to another. So if a published index is used, it's a good idea to convert the index to a series of values that are anchored on your designated base year, the year in which LIFO, dollar value LIFO, is adopted. And you can do that simply by taking the values of the published index and dividing each value, each year value of the index, by the value of that same index in the designated base year. So for example, if we had a published index where the value for the base year, let's just call that 2000XO, suppose that the index value was 220, and in 2000X1 the value is 231. Well, we convert those two values to, again, a series that is anchored in the base year with a value of 1 by simply dividing each value by the value of the index in the base year. So obviously 220 divided by 220 gives us 1.00. If we take 231 and divide by 220, we see that our index would be 1.05. And you can do that for every year thereafter. Again, and you have a series of index values that are anchored to the base year, where the base year index is 1. And so if a published index is not used, then we need to develop an index internally. And to do that, basically a representative sample of items from the pool is obtained, say, for the base year, and we obtain invoices relative to that sample of items to determine the cost of the sample in the base year. And we do the same thing for each year thereafter, and we use those costs, the summation of those costs, to develop a cost index by simply dividing the cost of the sample, say in X1, by the cost of the sample in X0. And once again, we get a series of values where the index value for the base year is equal to 1. Now, dollar value LIFO, again, is a method, so that implies there's a series of steps involved to it, and the number of steps that are involved depends on the source that you look at. If you look at different textbooks, they'll delineate the dollar value LIFO method typically in 3 or 4 steps. Here I've added a 5th step, which is to determine cost of goods sold at the end, but effectively we've got a few steps that are involved, and once you get these steps down, the method itself becomes fairly simple. There is an example that we will be looking at in conjunction with the coverage of these steps, We might look at the example first. It says that Paul Company adopted the dollar value LIFO inventory method for 2000 XO, and that would be the base year. Year-end inventory amounts and associated cost index values for the subsequent 4 values or 4 years are presented below. And so we've got a table that does give us the base year, 2000 XO, and then again, as indicated, the subsequent 4 years. And so for each year, we are given the ending inventory at year-end cost. So those would be the costs that have not had any inflationary or deflationary effects removed from those. Those will be the inventory values at the actual year-end cost for those designated years. I use a shorthand form of notation for that up in the steps, and I simply refer to that as the EI, the ending inventory, at YEC, at year-end cost, say for year Y. So in each year Y, we've got the ending inventory at year-end cost. And then we've got a cost index for each year, and as expected for the base year, the index is 1, as we talked about previously. The notation for this is just simply the cost index, CY, for year Y. Now let's go back to our dollar value LIFO steps. Step 1 is to determine the ending inventory for the current year Y at base year cost. So the shorthand notation there is the ending inventory EY at BYC for base year cost, then the subscript Y for year Y. By dividing the ending inventory at year-end cost, EY at YEC sub Y, as previously noted in our table, our problem table, by the cost index for the year, CI subscript Y, according to the following equation. So what it's indicated here is we determine the ending inventory at base year cost for a given year by taking the ending inventory at actual, say, year-end cost for that year and dividing by the cost index for that year. And we can, in our problem, do this for each year in a single step here, and this is going to give us, as we divide, this is going to give us the ending inventory at base year cost for each year Y. So clearly for the base year, 760,000 divided by 1 gives us $760,000. For the next year, we have 840,000, or rather 800,000, and we want to divide that by 1.04. And that gives us 769,231. Okay, 769,231. For the next year, we'll take 825,000 and we'll divide by 1.08. And we get 763,889. For 2000 X3, let's take 850,000 and divide by 1.1. And we get 772,727. Finally, for 2000 X4, we will take 860,000 and divide by 1.13 and get $761,062. Okay, so we have our ending inventory values for each year at base year cost. And we'll now go to step 2. So that completes step 1 basically for every year. Step 2 says to determine the current year's change in inventory at base year cost. The notation here is delta I for change in inventory at BYC for base year cost for year Y, as the difference between the amount obtained from step 1 for the current year and the amount determined from step 1 for the immediately preceding year, according to the following equation. So we're simply taking the difference between the base year cost for one year and the prior year. And so that's a simple thing to do here. We've got our values already determined, and we just need to determine the year-over-year change in value. So let's begin, and we're going to calculate the change for 2000x1 by taking 769,231 and subtracting 760,000. And of course that gives us 9,231. Now I'm going to put a plus sign in front of that for a reason. So that's an increase in inventory that we're indicating, of course, at base year cost. For the next year, of course, we need to take our 763,889 and we'll subtract the previous year's amount, 769,231, and that gives us a decrease of 5,342. The next year, we will take 772,727 and subtract 763,889 and get an increase of 8,838. And then finally we have for 2000x4, we have 860,000, rather 761,062, less 772,727. And that gives us a decrease of 11,665. Okay, so step 2 is completed for each year. And step 3 says use the sign of the result from step 2 to determine if the current year Y produced a new base year cost inventory layer or a LIFO ordered reduction in prior year's base year cost layers according to the following rule. And logically, if the change in inventory at base year cost was positive, it's greater than 0, then a new layer is added to our base year cost inventory composition. If the change in inventory at base year cost is negative, then there's a LIFO ordered reduction to prior year's base year cost inventory layers that's applied to determine the new base year cost inventory composition. So when we talk about a LIFO ordered decrease, that means that we will begin reducing the latest or most recent inventory layers at base year cost. And then in step 4, we will determine the dollar value LIFO reportable inventory amount for the current year by multiplying the remaining amount of each base year cost inventory layer by its year associated cost index and then adding the products thus obtained again to get our reportable inventory amount. And so let's see how this works in the context of our problem, which again is specifying that we determine the dollar value LIFO reported inventory amounts for each year, each of the years 2000x1 through 2000x4. So a good bit of the work's already been done. So 2000x1, we're mainly now going to focus on our inventory composition each year. Okay, so for 2000x1, there has been an increase in inventory at base year cost of 9,231. So we still have the 2000 XO layer intact, and so we're going to keep track of the year in which these layers originated. So we have the 2000 X1. Let's go ahead and add the word layer here, and that is $760,000 at base year cost. And each year we're going to be multiplying back by the index that existed when that layer came into being to get the reportable amount for that layer, or its contribution to the reportable amount for our inventory. So $760,000 is the 2000 X1 layer amount. Then we've got the 2000 X1 layer. And we have a 2000 X1 layer because the sign of our change is positive for this year. And that amount is $9,231. We need to re-express that in terms of X1 costs by multiplying that by the index for 2000 X1. So let's take our 9,231. Let's multiply by 1.04, again the index for 2000 X1, and we get $9,600, rounding to the nearest dollar. So that will give us $769,600. We can use our shorthand notation here as the dollar value LIFO amount for 2000 X1. So that's our reportable inventory amount. 2000 X2, situation there is that there was a decrease in inventory at base year cost of $5,342. So when there's been a decrease, again we apply that decrease to our base year cost inventory layers in LIFO order, last in, first out. So that means we're going to be reducing the most recent inventory layer first as we work our way up through the inventory layers. Now we'll see that again the reduction is $5,342 at base year cost. Our most recent layer has a base year cost amount of $9,231. So that layer is sufficient to absorb the current reduction in inventory at base year cost. So that goes to say that we will still have our 2000 XO layer still intact at $760,000. So we'll go ahead and again say multiply by 1 to get $760,000. The 2000 X1 layer, though, is reduced. There will not be a 2000 X2 layer since there's been a reduction to inventory. But the 2000 X1 layer is reduced by this $5,342 current year reduction in inventory at base year cost. So 9,231 is what the layer was at base year cost. So pulling that value and subtracting the current decrease in inventory, which was again 5,342. That gives us, or leaves us, with $3,889 of that X1 layer. Again, that is re-expressed in terms of X1 dollars by multiplying by the index for X1, 1.04. And that gives us, rounding to the nearest dollar, $4,045. So $764,045 is our total. This is our dollar value LIFO reportable amount for 2000 X2. Once again, there is not an X2 layer in that inventory composition because inventory decreased. Now for 2000 X3, we will see that there is an increase of $8,838 at base year cost, as we determined. So that means that we will add an X3 layer. So since there is a new layer being added, everything in our inventory composition for the prior year merely copies forward. So let's go ahead and do that. We have our 2000 XO layer $760,000 times 1.00 to give us 760,000. We have our 2000 X1 layer, 3889. Again, of that remaining, we've already got the multiplication done from the previous year, 4045. And now we are adding a 2000 X3 layer. At base year cost, again, it is the 8,838 amount that we need. 8,838. We will multiply that by the index for X3, which is 1.1. Again, you have to be careful here and pull off the correct index. You want the index for the year in which the layer originated. So that's the X3 index. And so we will take our 8,838 increase in inventory at base year cost, multiply by the X3 index, 1.1, and get $9,722. Okay, so let's add. So I can just pick up with the total I had last year, 764,045. Add that $9,722 year-end cost of our X3 layer and get $773,767. Again, we'll call that our dollar value LIFO reportable amount for 2000 X3. Well, we have just 1 year left. That's 2000 X4, of course, and there's been another reduction to inventory. This one fairly sizable. It's 11,663. So if we just consider that amount, 11,665, that's going to completely eliminate the X3 layer that we obviously just added, and then partially eliminate that X1 layer, because the two layers together add to more than $12,000, and the total reduction we need is 11,665. That means that our XO layer will still be fully intact, so we can go ahead and copy that down, 760,000. So we merely need to determine now how much of the X1 layer remains. And so if we subtract 8,838 from the total reduction to inventory, 11,665. Again, subtract the X3 layer at base year cost, 8838 from that. That says that $2,827 is the reduction now to be applied to the X1 layer. I'm going to change the sign of that, make that a negative. And now in our X1 layer, it's 3,889. I'll add that to give us the amount remaining of the X1 layer, which is $1,062. And again, being the X1 layer, we re-express it in terms of X1 cost by multiplying by the index for X1, which was 1.04. That gives us $1,104. And so we add, and of course get 761,104 as our dollar value LIFO amount for 2000 x4. And so that completes the requirements of our example problem. Again, I added a fifth step here just in the event that you, in a dollar value LIFO problem, are asked to compute the cost of goods sold for a given year. And if we remember the standard cost of goods sold computation, the determination becomes fairly easy, because we'll remember that our ending inventory amount that we obtain plus our cost of goods sold has to equal our goods available for sale. And our goods available for sale would be our beginning inventory amount plus our net purchases. And so our cost of goods sold for a given year, as already noted here, would be our goods available for sale, which is our beginning inventory plus what we've purchased, our net purchases for the year. So we'd say it's our dollar value LIFO inventory amount at the end of the previous year, which of course becomes the beginning inventory for the current year. Add the net purchases for the current year. That gives us our goods available for sale. Subtract what we didn't sell, which is our dollar value LIFO inventory amount for the current year, Y. And again, that leaves us with the cost of what we did sell. And so with that, I think we've completed the dollar value LIFO topic in sufficient detail to enable you to handle any question that you might appear, say, on the CPA exam. So we'll move on to additional topics.